Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Good evening, everyone. Welcome to MacroEdge Radio with a spontaneous explosion of X spaces tonight. Primarily because today's data was so shocking and today's markets were sort of beyond stupid, folks. It's not anything you see every day. And normally we plan these shows out further in advance, but my schedule has been fluctuating due to some new work requirements and engagements. It has been a little bit crazy, if I might add this. We are trying to sit there and effort as many guests as we can. We will take some listener calls tonight. We would like to hear what your local situations are, as anecdotal evidence is usually better than the Bureau of Labor Statistics, according to the President of the United States. However, if you have something negative to say about him, please don't do that. You might get us fired. So, just a quick announcement about next week's show. We will have an X Spaces next Friday night at 8 p.m. It will be an in-depth economic discussion with Deborah DiMartino Booth. If you've never listened to her, trust me, go read the book Fed Up between now and next Friday. You really need to listen to what she says. She's been on this employment data for over a year now, and I've been right there supporting her efforts because it's been suspect. But now we're firing the head of the BLS, more on that in a little while, and actually sitting here and trying to create this giant storm to keep markets inflated above realistic values. Well, folks, that's not how this works. That's not how any of this works. We can't sit there and maintain our country with questionable, if not downright suspect data and make investing decisions on trillions of dollars. I repeat, trillions of dollars based on fantasy and delusion. But I've been yelling, screaming, belly aching about this problem since 2007. So who the hell knows what's going on? Let's go ahead and hit the market update, which is colorful tonight, but not as bad as many of you might think. It's not the worst market data I've seen regarding this particular unemployment report. So the Dow was down 542 to 43,588, S&P 500 down 101 to 6238, NASDAQ down 472 to 2650. But volume was internals weren't that bad, although advanced declines were starting to get a little spicy. But we really didn't have any kind of major move. Only a little over 9 billion shares on the NASDAQ, 5.8 billion on the New York Stock Exchange. So for those in the bull camp saying, that's not a capitulation, granted, they have a point. It is not a capitulation. It is simply symbiotic of the problems that are starting to rot the foundation of the bull market that we all had comments and suspicious ideas behind since the bounce from the great revelation and savior saying, oh, we're going to suspend tariffs for 90 days. Gold, after a beat down for the past week, up 67.30 to 34.15. Silver up 39 cents to $37. Amazing it recovered that much. I really thought they were going to keep it down with copper. Copper, as I wrote about last night with Dr. Copper sitting on the table in surgery, might be starting to recover, up 8 cents to 4.44. Keep in mind, we were trading at close to $6 just a little while ago. WTI crude down 199 to 67.27. Brent down 226 to 69.44. A number I watched, the McClellan Oscillator, a negative 179.79. That's a pretty healthy reading on market internals. It does not mean we're going to crash. It does not mean the world is coming to an end. However, it does mean that there are some discrepancies starting to appear in the market for the bear bull argument, and we have to pay attention to that. Bitcoin down 23.20 after peaking at 119 on Tuesday, down to 113,650. Be careful, boys and girls. If you've been playing on Robinhood, you might get burned. The 2-year note after the data this morning down 26.7 pips to 367. The 10-year down 14 pips to 4.203%. 2's 10's up 13 basis points to 0.54. But more interesting, the 10's 3's down 10 basis points, reinverting to a negative 0.08. With that being said, I'm going to invite someone in right away because I'm not sure how much time they can contribute to the show. Pharma, who was on here several weeks ago. Pharma, how you doing this evening?
I'm doing all right. How about you guys?
We're doing okay, sir. It's been a very bizarre situation with the markets. The internals weren't that dramatic once I got a chance to peel off the onion and look at it. However, the sentiment went to hell in a handbasket. What is your reading on what happened, not just with the markets, but the fact that everybody got caught with their shorts down with the data, the bond market reaction, and everything else today, sir?
Yeah, I mean, look, it's what seems to happen every time, right? Sentiment just gets a little bit too stretched, positioning gets a little bit stretched, and then, voila, you get a catalyst that comes seemingly out of nowhere, right? When, it really shouldn't surprise us to see revisions, whether that's up or down. I mean, it's been a bit of a shit show in data for quite some time now, right? But yeah, I mean, it got to the point where, I came back from my vacation, and that usually doesn't bode well for markets. And, people were talking about, how, we weren't even going to see the 20-day, which was like a 1.5% below us at the time. And that just tells you that things are a little bit stretched. When people get like defensive about the possibility of a 1.5% pullback, then they're probably just a little bit too long, right? And so that's just how markets work. And, something's going to come out of nowhere to wipe that out. And that's, I think, what we saw really the last couple of days. I thought J-Pow was pretty hawkish. I mean, I was trying to listen with kids screaming in the background, but I mean, it basically sounded to me like he said, if shit breaks, we'll fix it. No problem. But, we're going to let it break first if that's what happens. And so to me, it kind of put me on guard for, the potential for weak data to be a problem because, for 2 years, when you had a hawkish Fed and the market was concerned about either hikes or not enough cuts, then soft data was bullish, right? The market would bid on soft data, pricing in more cuts or fewer hikes or what have you. But I mean, if it's gotten to the point where, Powell has basically said, we'll just fix it once it's broken, then, soft data is probably not really very good news for the market. But I really still feel like, at least for now, this is just a positioning unwind. And what happens with these, when these liquidations take place, they generally retrace pretty easily and rapidly once that happens, once it's all kind of washed out, right? Then the question is from there, do sellers decide to step in and, produce some kind of a lower high? So that's where I'm at with this right now. It's tough to say where it goes. I mean, you've got the back test of prior all-time highs, not too far below us here. And then really anywhere in between, today's low, because today's low, at least on ES, took that 62.41 low from a couple of weeks ago. SPX did not quite get there. That's just a function of ES contract decay as we move, forward in the quarter. But really, once that 6,200, I think it was 62.01 low on SPX is taken, it's time to just start watching for potential exhaustion in sellers. Because if you get a reversal back into that range, back up above 6,200 after a quick sweep, then it's a pretty quick trip to 62.80s, and then you start looking for whether or not we can get into the gap between yesterday and today and how that plays out. But really, anywhere between that 6,200 and then the prior all-time highs becomes pretty critical, right? If you get back below all-time highs, the prior ones, it starts to look a bit iffy. There's a few trap spots below there, But you generally don't want to make a new high by like a few percent and then fail back below that new all-time high. That does bring in some potential risk. I'm going to have to look things over this weekend really closely. I've already started doing that for the plan for the week, and I'll probably do a video this week because this really could play out one of a couple of ways. I mean, we could, obviously we saw a positioning unwind last August that was extremely violent. I don't know that I would expect that here, but it's always possible, right? You could get a violent unwind of positioning. I think it's probably not anything like that. But the problem here is that, in August, that didn't really do any major structural damage to the index. Whereas I feel like failing back below a prior all-time high here starts to look very iffy, given the fact that we took out so many prior lows. At low of year, we've put in a gigantic broadening formation or megaphone, however you like to describe it and draw it. It becomes a little bit problematic, and you can see some puke back down through 6100s down to even 5800s potentially. So, we'll have to see, and we'll give it a close look. But these things usually, the more aggressive and the more rapid it is, the faster they retrace. And so there's really no reason to step in front of a falling knife when it's like this. It's way more bearish to put in a good high. This is not a good high, by the way, on ES or NQ. It's not a good high. It's way more bearish to put in a good high and then see like a slow grinding sell over a period of a few months that really shows you that there are, committed sellers as opposed to just puke. And right now we're just seeing puke. So if you're looking to get long and you were trying to buy the dip all day today, I know there's a lot of bulls out there. There's no rush, in my opinion. You've got clear setups that are coming either right here, just below this last week's low and a quick reclaim, or you just wait until the puke is done, and then you can sit on some and ride it. And whether that's a rally, like I said, for a new all-time high, or whether that's a rally for a lower high, it doesn't really matter. You can get a lot of good juice out of it anyway. So that's kind of where I'm at before I really give things a close look here. But, we kind of needed this. We needed a little bit of rinsing of positioning.
Well, I think you've provided a good analysis because short term, I think everything is just stable as hell. I don't see any major move that's going to prompt a washout at this point in time. And some of the data, though, is suggesting some problems longer to intermediate term in the markets. Number one, you've got hedge funds borrowing topping 5.6 trillion. Just absolutely ridiculous amount of hedge fund borrowing. But at the same time, they're shorter than retail. A major concern for me is when you see the hedge funds far shorter than retail is usually wrong. There's a reason they're called hedge funds, boys and girls. And number two, it's very unusual to me, and this is a new phenomenon because of zero DT and all the crap that's been put out in the markets, ETFs on ETFs of ETFs. You've got retail heavily in the options market, most of them thinking, well, I have no obligation if I miss. It's like, guess what? Your black chips are still going to the bank, and then your car and your home and your Airbnb you invested in. I don't think they understand the nature of risk and a sudden violent market move. And percentage-wise and historically, your opinion is welcome on this. This really wasn't that violent a market move.
Yeah, not yet. Nothing too crazy. But, I mean, you're right with the amount of leverage that's in this system in both directions. I mean, obviously, we saw the move up. At times was violent and at other times was just sort of a slow grind. But there's just, seemingly unlimited leverage to push this market, whichever way it's going. And so, if it gets to the point where there's some meaningful supply trapped off sides, meaning prior buyers that, are stuck and have to sort of liquidate, and they're maybe chasing protection on the downside, and then you get, a little bit of chasing of the 0-day puts. I mean, we've seen these moves can quickly get exacerbated and get a little bit violent. But I agree, nothing too crazy yet. I mean, obviously it was a big gap down and go. But that really just, I mean, if you saw that open, there's no way you're executing a trade at that open, unless you're just kind of, slamming puts and have no stop or something like that. I mean, it was just straight down, just violent puke, uncontrolled selling. So very emotional. somebody had to do business, and that's never a good look for from the sell side. I mean, that is going to ultimately be easy to be retraced, but how far do we chase this down, and how much more puke is there to go? And I don't see it as any kind of huge washout. I mean, we're just back to, again, the weekly low from, I don't know, what, 2 weeks ago, 3 weeks ago. So it's not like this is some major pullback or something here, but coming into some important spots, and we'll just see, right? Like, I mean, big buyers are not going to step into this if participants, if big funds are still in the process of puking this out. So you have to be careful, with your support and resistance levels or whatever you look at on a chart, like in the middle of a sort of a broader positioning unwind and liquidation. Like, they don't mean shit, honestly. Sometimes, like, take the biggest ones and look for a response, I guess. But a lot of times levels don't mean a whole lot, and that's the same thing as when you see a short squeeze. That's also a liquidation. You can try to lean in and short something because you've got a level there, but you've seen it just gets blown through a lot of times because there's forced actions going on. And so that's why I say just kind of, let them get that puke out of their system. And then, you can look to trade it the other way. And then from there, we see how the data develops, right? I mean, we don't, like you said, it's more intermediate, longer term. Like, maybe there's some issues brewing under the surface, but like short term, I don't see us like, dipping into a recession tomorrow or anything like that, just because we had like one set of pretty gnarly ADP revisions. But longer term, you just kind of monitor the data and see if the ingredients for anything more, problematic arise. But, for now, like, even in the beginning of this year, I mean, when it was really, really nasty, I mean, that a lot of that was exacerbated by the fact that there was already technical damage. We were already in the middle of what was probably going to be a 10% correction. And then you got the tariff nonsense on top of that when the market, had serious technical damage. And so, that became an extremely large correction, but not a bear market, because you didn't have either A, the Fed hiking, or B, a recession, a big spike in employment. So, I mean, those are really kind of the big reasons that you would get a recession. Obviously, earnings recessions will do it as well, and so that's where we're at right now. Like, I don't see any reason for this to like immediately turn into a bear market. But we'll see, where this unwind takes us, and then where it comes back on the upside, and if we see some exits. But again, I don't think this is a good high at all. So my plan, anyways, is just to let them puke it all out, and then I'll take it back the other way and squeeze the late shorts, and then we'll see what happens. Another nominal higher high after that. As data deteriorates, then you might find me interested seriously on the short side in this market. So that's kind of where I'm at.
Okay, folks, if you haven't seen the video yet of Pharma with Ninja Trader Live, that is a badass hat and vest. I totally endorse it, sir. Number two, and I'm going to get your speculative input on this. I'm going to ask Six, who's going to join us here in a few minutes. What do you make of the idea, and that's just something I've been postulating for several weeks now, that the NVIDIA report and Jackson Hole might just mark the ultimate top, or close to the area of the ultimate top? Like you said, a bad top, a bad retopping process, and the potential dangers when you see very shallow volume moves. Technically speaking, a lot of the internals for some of the non-Mag 7 tech indexes, especially transports, isn't a crapper. I mean, it's 100% pure shit. No other word for it. I hate to drop the four-letter bombs on you people, but if you look at some of the equities that are the base of our economy, transportation, and look at the layoffs and planes being parked in the airline industry, what's happening in Vegas, and the number of bankruptcies of hotel franchisees, the data is starting to get a little bit scary if you're a bull. Agreed?
Yeah, I mean, there's no question that there is a bear market under the hood in select pockets, for sure. I mean, look at UPS. I mean, it's back at like COVID lows. I mean, that is just absolutely insane to see. You've got Lululemon trading about at COVID lows, just a lot of these names. And there's, various reasons for that. But I mean, this is, this bizarre market. Like, we've got this, K-shaped recovery in the economy. It's like we've got a kind of a similar situation in equities, where you've got, a lot of equities once again, and we saw this, maybe a year or two ago, where just a lot of sectors were just getting absolutely destroyed while AI goes nuts. And so, yeah, the risk there is that you put in, some kind of meaningful top in the AI names. And obviously you saw some of that at the beginning of the year with the, the scare, in AI because of the China, forget what it's called, DeepSeek or whatever it was. So that was sort of a nasty 1-2 punch. And so you've got, I mean, it really looked like Meta was looking into a topping process until earnings came along, and it still could. NVIDIA actually does now have a good high. So, I mean, if those start to sort of top out and then come in and make lower highs or something like that later on with a little bit of an expansion in breadth as there's some relief, and you're able to get NQ and ES to put in some kind of exhaustive good high, then that's definitely what I'm cautious about later on in this year. I mean, usually you would expect in a bullish year, which, as of now it is, that the last couple months anyways, would be quite strong. So, I mean, if we see anything other than that, if we don't see major technical damage by, let's say, the middle of October, and then the market is still not strong, then I think that's a warning sign. And then obviously, if there is some significant technical damage done by October, and we're trading red on the year or something like that, then that potentially could look a little bit gnarly. So that's definitely what I'm worried about on this. Once we do rally up, how do things look? How does breadth look? What do the semis do? Those big AI names, and do they continue to look strong, or do they put in, really good looking highs? And that's what I'll be watching on for, after I buy this dip, whenever that is. We'll be seeing if we make a sustainable new high, and then how those names continue to look, because that's going to be telling you as we move forward in the next couple of months.
Awesome. Great review and great market synopsis, because you and I don't think totally identical, but you conveyed the feelings of many people like, well, this is becoming suspicious. I better watch my six. And I agree with you. And real quick, before I bring on Sticks, tell everybody where to find you, and also warn people about not hedging your damn trades. There's too many morons out there that can sit there and think they can run naked into a den of wolves and come out alive.
Yeah. I mean, I play both sides. I like to say that my Discord handle says slap spoos both ways, and I mean I'll be long and short at the same time. I mean, there's nothing wrong with making money on both sides of the tape, and whether it's protection or whether it's just trying to make money both ways, it never hurts. And that was kind of the issue I mentioned earlier, is that when people were out there and they were so leveraged that the thought of a 1.5% pullback was like bothersome to them and got them angry. That's not really a good look. And so for me, we bought puts, a little bit early. And, what I said to my group, I've got a Substack, and then I've got a Discord separately, was that, like, look, I mean, we're still in an uptrend. This was, a week or so ago. So, size your put position, and we did put spreads first, such that if price, the index continues to go up, that your longs are outperforming any bag holding that you get from those puts. But I mean, if we do get some kind of a move in vol here, the puts are going to dramatically outperform the weakness in your portfolio. That's the beauty of convexity. So there's no reason to just be directionally short all the way up and just taking guesses and finding spots. But we didn't actually even take directional puts until yesterday. Actually, we had some on FOMC day on the way down, covered them, thank goodness, because we got the rip later on. But really just yesterday, adding directional puts on top of the put spread. So yeah, you can find me on Twitter, obviously at farmd_KS. You can see me on there and follow. I do ship post a lot, but I put some decent stuff out there as well. And then we've got the newsletter, and then we have the Discord, which are separate and priced separately for just depending on how much time you have. If you've got the time to be in there and learning in the Discord, or if you're just kind of looking to get an overview of what the market's doing and what trades might set up for the next day, that's kind of what the newsletter's for.
Farmer, thank you for hopping on tonight on short notice. And folks, make sure you follow him on X, Twitter. This is important now, because right now we are one of the higher risk eras of markets and what's happening economically. And unfortunately, it looks like politically we're going the same route. Real quick, before I hop on to Sticks, thanks again for joining us tonight, sir.
Thanks. You take care.
All right, man. Take care. Okay. So MacroEdge.net/ozone, MacroEdge.net/ozone. Don't miss out on this, folks. This is your opportunity to get a 2-week free trial. Read the material we promote. Read the materials we post. The team will bust its ass 10,000 times harder as market distortions accelerate. That's important because what's happening right now is the beginning of some potential over troubled waters. Sticks, you there?
Yeah, I'm here, buddy. How you doing?
Pretty good. Well, was today a fun day or what?
It was for me. So coming into that, and I would like to endorse to everybody who does more short-term trading. The last guy that was on Pharma, he really does have a good handle on being quick at identifying the very short-term moves. He's very quick to recognize the trend change. So I just want to call him out for anybody.
Okay, everyone, we're back, and we wish to thank X for giving us the usual high quality technical support, because after all, we have to pay attention to this nonstop. It's not like the old days where we had a board and the digital lines dropped and you simply sat there and plugged it into another one because it was redundant. No, this is the times where we're on the internet, and if anybody takes a fart or the wind shifts, apparently the X people can't handle any kind of volume in their X spaces. 6, you were on the beginning of a great discussion. Are you there, sir?
I'm here.
Please continue, because I haven't even got to the really good stuff about the NASDAQ and everything yet. So let's rip. Go ahead, sir.
Yeah, so I think I left off with Pharma was on last, and I was telling everybody that he's very good at identifying the quick shifts in the market structure. So hat tip to him. But I think where I excel, and my P&L would kind of agree with me here, is probably that my strength lies in kind of medium term, more structural macro row trends. And, that's kind of where I shine. I tend to generate the bulk of my P&L. We were talking about this in one of our private groups today, but I tend to generate the bulk of my P&L, fortunately or unfortunately, when the world is kind of going to hell. So today was a great day for me. I had a twos, 10s, 30s, steepener on, twos against the 10s and the 30s. It's not a fly. But, long the 2-year notes with lots of leverage, and short 10s and 30s. And yesterday, and I tweeted this out yesterday, but I'm not really sure even exactly why I did it, but I just got the feeling that I really needed to drop the steepener leg of that. We came into this week, last weekend I was tweeting, that this looks like, and I'm certainly not the first person to have this thought, but it really looks like we're either, the market is very extended. Everyone is looking at the valuations. Everyone knows where we are in the cycle. But the market is getting very expensive. The capex in tech is just off the charts. It's absolutely unbelievable. I think Besson said it's going to add over 1% to GDP this year, which is enormous for capex, especially in just the AI capex. But it looks like we are, at least earlier this week, to me, it looks like we may be in an absolute melt up where it's if you look at the chart of the NASDAQ in the 90s, there would have been multiple points on that chart where you would have thought that this is absolutely ridiculous. This cannot continue. And if you were to short it at any of those points, you would have gotten. John, can you still hear me? My app is.
You are sounding perfect. So no, you're good.
Okay,
You're
good.
good to rock and roll, sir. Keep it going.
Yeah. So, if you were to look at the chart of the NASDAQ at any point during the later 90s, you would have thought this is absolutely ridiculous. I should not only close my longs, I should go short. And, you in the moment, you may have been like, the valuations would have told you that would be a good idea. And then you would have gotten your ass handed to you in a big way. I subscribe very heavily to kind of the methodology of George Soros and Stan Druckenmiller. Obviously, their P&Ls speak for themselves, but I kind of have tried to emulate their style of trading. I think that they are just fantastic, and obviously they are. Their track records speak for themselves. But regardless, Druckenmiller famously went short in the later part of the 90s, when valuations started to look ridiculous, he shorted $200 million in tech stocks. That turned into a $600 million loss in the span of a few weeks. He was down on the year. He hired a few, young tech-savvy kids that knew all about all of these different companies that he had no idea about, and they basically, kind of washed him into, let's get long this tech bubble. And then he switched along, made like 40% or something that year. Everything was going great. Then at the end of the tech bubble, he bought right at the top of the tech bubble and lost a few $1 billion. But anyway, there was a point where the market in the end of the tech bubble just melted straight up, and it looked like that is the direction that we could be heading, and it still possibly could be. But I mean, earlier this week, I've been putting on some volatility hedges on the long side. I'm long volatility, long the 2-year note. The thing that I'm watching right now, and we could shrug this dip off and go on to make new highs, and this is not necessarily a time to sell your stocks. I think it is absolutely a good time to add hedges, and there's not always a good time to add hedges because hedges are most of the time, a drag on your P&L. A hedge is designed to either protect you or expire worthless. And it's not always a good time to be carrying those because they are always a drag on your performance as long as things are going the way that they're supposed to be going. So keep that in mind.
I don't want to interrupt you too much, Peter, but I got a question.
Yeah.
With vol as cheap as it was at 14, 15,
Yeah, I had to.
was
you
that
have
not
to
a
slam
bargain?
that. Yeah, you have to slam that. Trump is still the president, and we were going into the tariff deadline. Like I couldn't believe that we were. I mean, obviously he's shown that he loves the taco around, but they gave us 14 on the VIX going into like a Liberation Day light, like the light beer of Liberation Day. But and maybe we do climb right out of this, but now the narrative has the potential to change. We have the market that is now coming to grips with the fact that these are like I don't know if he walks this back. He very well may walk these back, but like it looks to me like these are solidified tariffs. Like these are the new deals. Like this is how it's going to be. And the effective tariff rate just settled at, I think Fitch said, like across the board, the effective broad tariff rate is going to be somewhere in the range of 17%. So, I mean, like it was always kind of wishy-washy before this, but now that's assuming that there's not big tacos to be served for dinner, that's going to be the effective rate going forward, or at least something close to there. So now that has become a tangible number. So the market is going to have to digest the fact that maybe these aren't going away. And we're going to be left with the biggest tariff since Smoot-Hawley. And, we're still doing almost $2 trillion of fiscal QE per year. There's still the deregulation. There is still, the very obvious bias of the administration to manipulate stocks higher, and you cannot discount that either. It is a major driving force, and the rhetoric around the administration in an era of fiscal dominance, you have to look at it like almost like Bessent is the new Fed chair. Like that is the way that you have, like when the fiscal side is the dominant side of the financial mandate, you have to look at it as though Bessent is the one in charge, not the Fed chair. So in most of history, the Fed chair is like the god of the financial markets. When we're in fiscal dominance, you have to look at it like Bessent is the god of the financial markets. So you cannot discount the direction that he is trying to take financial markets, because just his rhetoric alone, and this does not necessarily apply to like daily or even weekly price swings, but the direction that he is actively aiming to push markets, you have to have a bias in that direction on a general basis, if that makes sense.
Oh, well, I'm going to throw a historical reference at you
Yeah.
because you know how I am about history because I'm the biggest asshole in the world about history. Does the Bassett not sound a lot like Andrew Mellon?
Like who?
Andrew Mellon,
Uh,
Secretary of the Treasury, 1928 to 19. Well, he served in it from 1921 to 32.
I'll have to
But
admit to my complete ignorance about that.
let me put it to you this way: this guy was absolutely absurd, and the reason I bring this up is because he encouraged the same kind of speculative bullshit that we're witnessing in the markets today. I mean, I'm going to go through this real quick with you because I want to get to Mr. Awsumb here in a minute. But today's most active stocks on the NASDAQ, and you tell me your opinion of the viability of technical analysis on the NASDAQ, broader NASDAQ, not the 100. Your four largest stocks by volume. RAYA is the symbol, Ariac Power Solution Group, up 41% to 8 cents per share, 565 million. Lobo, LOBO, EV Technologies Incorporated, a quote-unquote auto manufacturer, up 119% or 42 cents to 78 cents a share on 420 million shares. Tenon, TENON Medical, symbol TNON, up 43% or 44 cents to $1.46 on 234 million shares. And EQ, Equilium Inc., Biotech. God, I love the days of gambling on biotechs. It was better than roulette. Up 81.59% or 31 cents to 71 cents a share on 142 million shares. So you have over a billion shares rallied up on crap. You have the 0DT options. You have retail outpacing hedge funds on investment. Does that not scare the living crap out of any rational investor who's been in this, had skin in the game, actually lost money, and actually participated through some bear market cycles? Because I don't know about you, but it scares the living crap out of me. And I go back to historical references. I'm going to give you one more story, and it's part of the article I'm writing for Sunday night on macroedge.net/ozone, macroedge.net/ozone. Here's the deal. On August 1st, 1929, the banks started calling loans. At some point, margin requirements are going to be raised. We won't hear about it unless you get a notification. Doesn't that concern
Can you hear me, John?
Yeah, you're fine. You're coming through clear, sir. Does not the idea that the idea of increasing margin requirements, of credit no longer being extended, not just to the public through what we're seeing, but the gamblers, the Robin Hoodies, does that not scare the living crap out of you as a long-term investor? Oh, you can't hear me. This is not good. Can everybody else hear me? Somebody say something in the room. Anybody else? Mr. Awsumb, can you hear me?
I got you loud and clear, John.
Okay, it's just Six who's having a problem. So what we're going to do is we'll wait to see if he comes back. Yep. Thank you, Elon Musk. Everybody can hear me, so I'm getting the signal. So it's just Six. Sorry, Six. I'm sorry about that. See if you can leave and come back, and we can take it from there. Ulysses Awsumb is joining us here. And folks, I'm going to tell you right now, what's going on in this market is something to behold. I don't even know where to start with this, to be honest. We're watching a real estate market which is going insane. And I honestly believe that we're going to have a problem far sooner than most people are anticipating. You've been writing some fantastic articles. If you're not reading his stuff at MacroEdge or on Substack, I'm going to tell you right now, boys and girls, you're missing something. And if you understand the intricacies of what's going on with our interest rates, which right now tanked. I mean, I talked about the 2-year and a 10-year. That's great. But we've heard the president beat the living crap out of Jay Powell for weeks now about high interest rates. Yet Jay Powell has no influence over the 10-year note, the 30-year, et cetera, those instruments which influence mortgages and financing. Does this not scare you that most people don't understand the difference between interest affordability and price affordability? And you take it from there, sir.
I guess I wouldn't say it's scary. I think it's unfortunate that a good portion of the country doesn't um understand the difference. But what do? I guess that's why you start writing and you join MacroEdge and you publish the information so that it is out there for people to learn and understand. For those that haven't paid attention, to your point about sort of softening in the bond today, for the traders out there, there's a giant red candle on the 10-year that went along with a little bit of softness in the stock markets. And to your point regarding the Fed chair and taking some blame over a race, I would agree it's probably time for Powell to cut based on some of the softening employment data, despite everyone's concerns about inflation. But the reality is that the Fed cutting rates isn't going to affect the either the 10-year bond yield, because that's not what the Fed excuse me, Fed fund rate does. It doesn't target the bond yields. And it's also not going to address the mortgage affordability, because mortgage rates are based on spreads that lenders are able to get above and beyond typically the 10-year bond yield. So cutting the effective federal funds rate isn't going to create a situation where all of a sudden mortgage rates are going to go down. And then even if they go down, let's say 100 basis points, 200 basis points, it's going to open the doors for some residential real estate transactions, whether that's existing homes sales or new home sales. It's not going to alleviate what everyone is discussing as an affordability crisis right now, because the reality is even at 2 percentage points or 200 basis points lower on a 30-year mortgage, the difference between what the median price home or what a lot of these builders are putting out or what's on the market, that's not going to suddenly open the door to another 20% of the population. It might be 10% of the population as potential buyers, and of that 10% of the population, only a percentage of those are going to be buyers. There's still going to be a big segment of that, those folks out there that aren't looking at transacting the real estate market.
Ulysses, I just have a question for you about real estate. Just to follow up on what you've been saying, how do you feel about the fact that about the median housing price to the median income ratio on a historical basis? I think that ties right into what you're talking about.
Yeah, it does. So I will address that from perspective of the home building side, right? So if I'm going into a market and I say I want to have the largest possible market share being addressed, right? We hear this in IPO world, total addressable market share. How many people are you going to be able to have transact? Now, we've got to address the reality that most people buy with a mortgage. So what they're really doing is they're purchasing money. They're buying money from a lender with a mortgage deed, and to guarantee pay that back over 30 years. So if you want to have the most amount of people capable, you're going to need to address at least half the market in half the demographics of that market. In order to do that, you can look at the median household income. So let's say you have a market that the median household income is $80,000. That might be comprised of two earners, a single earner. Regardless, what that tells you is that 50% of that market makes less than $80,000 per year, and 50% of the market makes over $80,000 per year in their household income. So you want to be at a price point where, if you consider 25% of that median household income's earning, they have the ability to make the payment at the current mortgage rate and their current price point for your new product in order to expand the market. Otherwise, you're looking at the higher end of the market in whatever area you're selling. So it's an enormous component of especially builder real estate, addressing affordability for 50% of any given city, MSA, targeting that median income buyer profile because you're going to expand your potential audience, your potential buyers.
Well, that brings me back to the conversation. Ulysses, oh no, not again.
We can hear you. We can hear you.
We can hear me good. It
Yeah.
scared the hell out of me there for a minute because the screen blanked for a second. You know how that rolls with X. By the way, everybody, Elon Musk is a brilliant man. You would think he would figure out an audio program that wouldn't crash every 30 minutes. Just my opinion. Ulysses, when you're looking at the bigger picture of what's happening, though, is not the trap been laid? You have the elderly trapped in homes they can't afford to maintain any longer. You have a younger generation that can't afford to absorb the McMansions that the builders decided to build for whatever damn reason. We said, oh, we need 5 3s everywhere in the United States. Hey, guess what? They need 2 1s that they can afford. There seems to be a problem and a disconnect between let's get greedy and finance everyone into this crap with the reintroduction of ninja loans this year. God, Jesus Christ, that's going to be a disaster. We seem to have set the table again for a scenario once the foreclosures and student loan processes and collections begin to really zap the regional and community banks into oblivion, plus put a new burden on the taxpayers to bail out Fannie and Freddie and all the garbage they've been up to. That doesn't even bring into the fact of ABS and other securitized financial instruments, which are pretty much going to lose 10 to 20% of their value as the foreclosure process starts.
Was there a question in there, John, or was that?
Well, where do you? I'm sorry, I just sat there and went on a rant. But my question for you is more of: is this not being taken into account by the real estate industry? I mean, the National Association of Realtors is promoting Happy Days again, and been promoting this BS narrative that everything is fine, people can afford these homes. But when you look at the hard numbers, it's not true. It's total BS. And it's going to cost the economy because that's the last shoe to drop. We've already had hints from the trucking industry of how bad housing is. We've had hints from the construction industry how bad it is. We've had hints with 9-month plus supply and growing how bad it is. And we're seeing people pulling their listings off the market because they can't get the price they have to get out of their mortgages. Is this not the same sequence we followed in 2007 to some degree?
To many degrees, yes. But I would also say, it depends on where you get your research, right? Sell-side research is designed to sell. The National Association of Realtors represents its members, and their entire job is to transact residential real estate. And so I look at it like, of course, they're going to put something out that is going to create an incentive to induce people to buy, because that's their job. Now, you can make a judgment about that or not. I don't necessarily pay too much attention to the research that they put out because I think there's some good data points that they do publish, but I'm not going to look to them for economic guidance on the situation. One of the things that we do have going on that's very similar to pre-financial crisis, and I would argue extremely similar to every recession, is as the business cycle expands, credit gets to a point where it becomes easy. People borrow a lot of money. Housing hits a straining point as far as affordability, and builders, in the excitement of easy sales, always tend to overbuild to their markets. Having been in the industry, I can tell you that I've had more than one CEO tell me they invented the phrase, make hay while the sun shines. But then it always ends up in the same spot, rather than setting a reasonable pace. And one of my criticisms of that mentality is the concept of supply and demand. If you're flooding your own market with supply, you're creating an environment where you potentially have negative pricing pressure. Now, as a builder, as a manufacturer, as a business, anytime that you have negative pricing power, you lose the ability to expand. You the revenue that you generate by increasing the sales price, you're in a potentially bad situation. And then when it starts becoming negative and you have to continuously reduce your price, well, you are in a bad situation. And what we're seeing is that much like prior to 2007 and much like prior to several other recessions, we've had now over 2 consecutive years of negative pricing power for builders. Back in October of last year, at MacroEdge, I published a look at the XHB, its components, and the forecast of Q4 and what that was going to do to home builders as far as the selling conditions. For those that aren't familiar, I've created a composite index that tracks basically the price direction of mortgage rates, the supply of new homes, and the sales rate of new homes to show the effect that has on the market. And builders have since taken an enormous beatings in their stock price. And of course, as those selling conditions remained depressed, what we saw this spring was an enormous issue. So the first quarter of the year, first fiscal quarter, you had builders reporting up to 67% decline in net income. And as of yesterday, with Beazer Homes reporting, we actually have our first home builder, publicly traded home builder, that has a quarterly year-over-year loss of income, right? So not just decline in net income, actual losses from operations. That's a rarity, and that is something else that also happens only in conditions that are not economic expansion for home builders. Beazer joins, some other publicly traded builders that have reported, and it has not been a very pretty quarter so far. Meritage Homes is down 36% net revenue year over year. Lennar was over 50% decrease year over year in net income. So we're seeing that compression in net income, and right, people like to talk about gross margins, but what does that matter if the net, what you actually bring home, is being cut in half? So what if your gross margin stays the same, but your net decreases? So yeah, we're seeing a lot of those same pressures now, where the cost of money is still high, and the rate of sales and the need for incentives, even from people that subscribe to the trade industry groups like the National Association of Realtors or even the National Association of Home Builders, they're sort of feeling the opposite end of things, where it's becoming much harder to push the agenda and get sales out the door.
Well, this brings to mind a question, because you and I have had we have a private chat, folks, because all of us brainstorm. They listen to a lot of bullshit that I throw out there and get a good laugh out of it. But I got to throw this out to Ulysses tonight, because this is very important for the discussion. And that is, do you feel like, paralleling the prior crisis that we had in real estate, that the builders have started withholding inventories by failing to get final permitting processed on completed but technically legally incompleted buildings in construction, to sit there and keep inventory off their book, and thus reduce the picture of, hey, everything is awesome and you can get 5% kickbacks if you buy a home from us?
Yeah, and I've heard that. I can tell you from experience working for a publicly traded builder. I can tell you, working with clients on a regular basis that work with publicly traded builders, there's always some communities that are completed that are not being listed, right? So home building, you want to have future product as well. And so one thing that home builders do, they measure their lot supply in years, right? And if you read through earnings, if you've ever been in the business, you'll know this. They don't talk about having, we've got so many months of sales of lots. They have years of lots, because they need to be planning years ahead for the continuation of the business. So when they've got a community that they've got replacement communities that are going to exist to replace communities that they have sold out of or are close to selling out of. They've got expansionary communities, because just like somebody that opens a franchise, a series of franchise restaurants or auto repair shops, it's a bigger footprint. You have more stores, you have more communities. So there's always going to be some communities where the projects, you have completed homes that are not listed for sale. Usually those are going to show up in builder earnings as inventories somehow, whether that's in backlog or completed units. But then there's the Census Bureau survey, which is an entirely different concept. Um, so when that, they actually don't even measure it as a permanent, right? So the census actually sends out a survey to builders. Builders file responses. They get a phone call and follow up. And then somebody from the census goes out and they do checks. And then, of course, extrapolate the results across the country. But their substantial, a completed home, substantial completion is when it's substantially done. It's got flooring, it's got countertops, it's got lighting, it's got working plumbing. So even if there isn't a certificate of occupancy saying it's officially complete, the census counts that as a completed home. It could be lived in and sold. So there's two different methods to measure it there. And I guess that's a really long way of saying, yeah, there's always going to be some houses out there that aren't listed for sale. I wouldn't call it shadow inventory. I call that business planning from builders. But when you look at the total volume of what we even have for reported houses, 511,000 new single-family homes available for sale. That sounds like a small number, but it's actually the second most recorded in history since we started recording the data. And it is within 11% of the record set in 2006. So take that for what it is.
Well, that brings one final question because I appreciate you taking time out from your evening on such short notice to join us tonight. And this is really an interesting perspective that I'm getting now uh, from the locals. So I can't translate Florida to the nation. That's obvious. But commercial real estate's in a lot of trouble. And I don't mean just restaurants, warehousing, et cetera, but also retail and multifamily. And most people don't view multifamily as commercial, but that aspect of CRE, is this an overbuild disaster waiting to happen? Because I'm still driving by communities that are 30, 40% occupied 1 year after completion. That's not sustainable for the investors.
Yeah, I would agree that that's not sustainable at all. Yeah, and we have a lot of areas that's massive, call it overbuilding of apartments. You've got areas where a lot of brand new apartments are offering incentives and discounts. So you might get 3 to 6 months rent free, or they might be throwing in other goodies. I saw a couple really ridiculous ones even posted on X or Twitter the other day. It was essentially 6 months free, and no down or no security deposit, which I've never even seen that before. But um, the more supply floods these markets, the harder it's going to be for them to fill them up because you're giving options, and then a lot of the apartments that got acquired in 2020 through 2022, we have already seen a lot of those, and even some older. People that overpaid for something like 1960s to 1980s vintage apartments. A lot of them would be maybe 2, 3 stories, or your garden variety apartments, with the expectation that rents were always going to keep increasing at the rate that they had, most recently. But again, back to Six's point about the median income, at some point, there's just no more juice to squeeze out of potential renters, and the people that can afford it, they're just looking at an entirely different set of options than, what's available, those type of units or apartments, those price points. So again, targeting the wrong demographics or not looking at it, or um, overpaying for some of these. Yeah, there's definitely going to be in there. There is pain going on. I think one of the reasons you mentioned the banks, that we're not seeing even more pressure on banks, is because some of the differences in funding of a lot of these, where over the last few years there's been a lot of general partners that have raised are syndicated funds from multiple sources. So you've got investors that have funded a good portion of these, and maybe they're getting wiped out or they're getting cash calls, but they're making enough money where they're able to pay the interest on a loan, and so they're getting loan modifications. And there's been a lot of that as well. Um, and then, of course, you've got spots like Houston, where there's a tremendous amount of older vintage apartments that are going back to lenders, that their prices are being slashed. Um, and it actually reminds me a lot of the late 1980s, early 1990s cycles. Houston, in particular, had the same problem with apartments. And of course, you are correct about, office and a number of retail definitely is facing some struggles as well. So.
Yeah, my fear now is logistics and warehousing, but as the inventory we've channel stuffed in for Q4 filters out, I got a bad feeling we're going to see a lot of CNI problems coming forward. And you hit the nail on the head. This is going crazy. Sir, remind everybody where to find your Substack and, of course, at macroedge.net. And then I'm going to grab 6 for the closeout here.
Fantastic. Thank you very much. You can always read my work at macroedge.net. And I also publish another newsletter weekly at thememo.net.
Fantastic, sir. I appreciate it. And what I'm going to do now, we have a guest who wants to on. Joseph, are you there?
I am here.
Welcome aboard to MacroEdge Radio. I appreciate Mr. Awsumb coming on and bringing us the real estate perspective, which is lurking in the background as we approach the foreclosure and forbearance suspension. What do you bring to the show tonight, sir? Because I saw your note about the layoffs, and that is 1,000% accurate. People are not paying attention to a lot of companies shutting down branches and locations, including UPS, as discussed earlier, and a lot of other locations. We seem to be stumbling into a blind spot here.
Well, yeah. So first of all, I always see MacroEdge every day. First of all, people don't know, I track through all the war notices, through all the different states and all the news feeds, what companies are letting go staff. And so I put out a summary every day, and I have all the backup for these in my feed. And I always have these archived. My background, though, is, well, I go back in time. I started off my first full-time job in San Francisco at Schwab in '87 and saw that meltdown. I was here in San Francisco during the dot-com bust when I was working at a telephony data installation company, and we had all those wonderful dot-com companies here in the Bay Area that went bust. The only thing that saved our asses, of course, was the fact that we took 90% deposits to cover the cost of all the Cisco equipment we had to install. So we didn't actually have to die. Although I was asked to come in and work on contracts for friends I had at Ask Jeeves at the time because their book was a disaster. And then during basically the 2008 meltdown, I was at CBS Paramount, where all of a sudden I found myself on weekly calls with corporate because we were monitoring companies like Ford and GM and Chrysler back in the day because they were all on bankruptcy tithers. So I spent a lot of my time working over the last couple of decades, working in companies, extending corporate credit. That's kind of my big thing. And that's how I kind of look at a lot of stuff from that sort of like frame of mind, corporate solvencies. So as you've been talking and I've been listening, am I concerned about a slightly higher interest rate? I'm not really necessarily. And only because I look at it kind of different than some people here. From my perspective, I want to make sure that there is basically fiscal solvency and fiscal, diligence being played out by companies and by individuals. And when you have a slightly higher interest rate, people can't just necessarily just pay off the interest on loans, and they have to be a little more careful. So I'm